Right, welcome to this webinar. I think we have about 140 people in now, and it's time, so I'm going to get going. We have many more people than that who are registered, but I expect perhaps not everyone will attend. Okay, so welcome to this EDHECinfra webinar on the Q1 2020 release of our indices for unlisted infrastructure, equity, and debt, with a focus on the COVID-19 impact on performance and risk. The release includes several hundred indices, in fact. There's a list on our website if you look under index family. But in this webinar, we will be focusing on the main market indices, in particular the infrastructure 300 or infra 300 on the equity side, and the broad market project and corporate private infrastructure debt indices as well. I will be your host today. We will be your host today. I'm Frederick Bromrud, Director and Founder of EDHECinfra, and I'm joined by my colleague Abhishek Gupta, who's heavily involved in the design and the production of these indices. Abhishek, you say a word?
Hello, everyone. I'm a research engineer and product specialist at EDHECinfra. I'm quite pleased to see so many of you joined in this webinar. I hope we can make it worth your time.
Okay, so a few words of housekeeping. We will talk for about 30 minutes, and we'll try and keep 15-20 minutes for questions and a couple of poll questions. Now, because there's many of you, we're going to try and take all the questions in writing and then answer them as we go, as opposed to letting you talk, because otherwise it's going to be a bit complicated. We'll see how that works. So please use the Q&A menu at the bottom of the screen, or maybe at the top of the screen, either way, to add your questions, and we will aim to answer them at least today. And if we're not today, then we'll send a follow-up email with all the answers to all the good questions later on. This webinar will also be recorded. All right, let me just say a few words about EDHECinfra for those who don't know us. We were created 5 years ago now at the EDHEC Business School. We have teams in Singapore and in London, and we were originally funded by research grants, in large part by the Monetary Authority of Singapore and by several private sponsors, including some well-known names like Natixis, Meridiam, the members of the LTIA, Campbell Lutyens, the hub of the G20. We also had sponsorship from a number of asset managers like AXA, IM, AMP, Spring, etc. More recently, Landmark Partners as well. A number of industry players like this who choose to put support behind this research, but this research has now reached its new life, so to speak, and now we've pivoted to a fully commercial model by which we are still at EDHEC, but we are a provider of indices to asset owners, asset managers, and consultants primarily. This being said, we've retained our academic DNA, by which I mean that we try to do things properly. And we like to think that we have a mission, that we create social value in the finance sector, so to speak. And that mission is to help the infrastructure asset class develop thanks to a better understanding of risk, better definitions, and also better data. So today, our agenda is quite simple. First, I want to tell you a little bit about our coverage of the unlisted infrastructure universe and how and what our indices track really, and also how we approach the question of measuring performance in unlisted infrastructure on a quarterly basis. Now, rest assured, this is not a technical presentation. There is no equation. I'll just remind the audience of how we do things in a very high level manner. And then we will look at what we released on April the 15th. Normally the indices come out on the 10th of the quarter, but there was Easter this year. So we waited for the 15th to release them. I'll give you the big picture, and then my colleague Abhishek will take over and show you some of the detailed results. And I will then return after that to ask you a couple of questions on what COVID-19 means for infrastructure indices and for benchmarking, and we'll also try and take some of your questions. Okay, but first, as you'll see, what we do requires a great deal of effort. And so you might ask yourself, why go to this lens just to report the performance of a very illiquid asset class like infrastructure? Well, it's because, of course, infrastructure investment is very important. And there is an issue with existing unlisted infrastructure indices, which are based on appraisals, They are wrong, very wrong. They have significant data issues, selection biases, reporting biases, survivorship biases. They show an asset class with almost zero volatility and a Sharpe ratio of 4, which we all know doesn't exist, and zero correlation with all other asset classes. Now, while this is sometimes a good story, it's obviously not a true story. So these indices are completely useless for risk management or even for performance tracking. And as you know, investors instead use absolute return benchmarks. What we know about absolute return benchmarks is that investors do not like them. In fact, we did a survey with the G20 last year in which 90% of asset owners declared to be unhappy with their absolute return benchmarks. And guess what? The COVID-19 impact on infrastructure performance has just made these absolute return benchmarks completely useless as well. So that's why we bother doing what we do. In terms of our coverage of the universe, let me tell you a bit about our approach to building market indices in a scientific way. So we start by selecting 25 markets, which are the most active and therefore qualify as principal markets in the IFRS 13 parlance. This means that these are the markets where there are enough trades to measure fair value through transaction prices. We have market inclusion criteria, including minimum size, minimum level of activity, and minimum availability of data, and that gives us these 25 countries. In these 25 countries, we identify 5,500 companies that also meet some minimum inclusion criteria and qualify as infrastructure companies under the TICCS or TICS taxonomy. So that means that these are investable private infrastructure companies. Incidentally, we size up this market by book value of total assets, which is the only metric that you can get or at least estimate for all these markets and for all these companies. And we find something like $2.1 trillion of total asset value for these 25 markets. Using the ratios we can produce from our asset pricing models, that gives us something like 2.8 trillions of market value, 1.3 trillions of which is equity. This is very new results, by the way. We've never published this, so I'm kind of putting this out there today so I can get some of your reactions as to the sizing of the market. But this is the market, this is the universe we're trying to track. Now, of these 5,500 companies, we selected 650 with the target to track the universe as best as possible, with the aim of covering each country by that 50% by book value, and matching the different TICCS segments of the universe. So TICCS, I'll just come back to that in a minute, is a taxonomy system, a classification system for infrastructure companies, which allows us to understand better which companies go in which sector and which business risk bucket, etc. So from now already, any issue of selection bias is controlled and is transparent. You know exactly what is in the index and how it relates to the universe, because I'll give you the universe as well. And because we select these firms over time, we also have no survivorship bias. In other words, we don't just have winners in the index, we also have plenty of losers. So we're going to start understanding risk a bit better. So the TICS, or the Infrastructure Company Classification Standard, is a taxonomy that can be used to categorize infrastructure investments in an objective manner and by relevant peer groups. It's something we produced a couple of years ago. It's now been reviewed. There was a market consultation last year. We have an independent review committee, which also provided its feedback for a new edition a few months ago, 2 months ago. And as you'll see, when we had to determine which infrastructure were impacted by COVID-19, TICS proved to be very, very powerful. So it's already something that has proven its value, so to speak. Now, here you see a breakdown of the same universe of 5,500 firms in 25 countries, also by value. And you can see that on the left, we have the contracted segment of the infrastructure asset class, which is a little under half of the sector, while merchant assets, which are exposed to business risk, also are about a quarter, and regulated assets are about 1/3. So that's one way to look at this universe, right, in terms of business risk. Another way to look at it, the second pillar of TICS, is by industrial classes, industrial activity. Here you see that transport, for example, and network utilities, that's the central chart. Each correspond to about 1/5 of the universe by size. And finally, the same universe can be broken down between corporates and project finance SPVs, which is another interesting way to look at things because they're quite different. And we see that corporates, while being much larger, are also less numerous. There are many, many more projects. So by value, they end up being roughly half the universe each, a bit more on the corporate side. Now, this is the universe. Now, let me describe briefly how we treat the 650 companies we selected in our sample to try and track the performance in this universe. So it's really a story of humans and computers. It starts with the humans now. For the 650 firms that we track, we have human beings compiling and reviewing the raw financials, the debt structure, the history, any relevant information about these firms, and analyze them as you would if you're a financial analyst with a specialist knowledge of certain infrastructure sectors. We call these humans the data team. They also produce forecasts of the revenues and of the debt service of these companies. And this will be instrumental later on in our ability to predict the impact on COVID-19 and especially the COVID-19 lockdown. I'll return to this in a minute. Now, the data collected by these analysts is then fed to computers, which are very smart and use it to predict dividends. So I've got no time here to go into the details of how we do this. There's plenty of documentation online, and also we can take questions. In fact, we'll probably do a webinar one day on how our cash flow models work, but not today. Suffice to say that the computers predict the dividends based on all the data that the analysts have checked and analyzed. The same analysts also collect transaction prices that are relevant to the valuation of unlisted infrastructure companies and also update this information each quarter. Now, this price data is used to calibrate DCF models, both for equity, but also for debt, and compute the price for each firm and for each debt instrument at the end of each quarter, given the data available at the time and the prices that are prevalent at the time. Also given the interest rate curves at the time in the country where the company is. So this approach ticks all the IFRS 13 boxes, and it presents the advantages of getting much closer to fair value prices than appraisals would. As a result, we see that the valuation of unlisted infrastructure companies sometimes change. In fact, it changes every quarter. So we're going to start to see a bit of where the volatility and the fair value lies in this asset class by doing this. Okay, now let me go to the release that we just put out. Now, infrastructure businesses are usually impacted by the tail end of recessions, of course, but here from the onset of the COVID-19 crisis, it was clear that infrastructure was going to be impacted before every other businesses. In fact, the initial phase of this crisis was not an economic shock, but it was a state of emergency requiring nationwide lockdowns, effectively shutting down most key transport links. The impact of the ongoing economic recession on infrastructure investments then comes later. In fact, we haven't even seen it yet. So in this release, we thought that we would capture the impact of the lockdown as of the 31st of March. This is really what we're capturing here. It's not yet any kind of economic shock that will impact, say, the transport sector or the power sector on a more permanent basis, perhaps later. This is really just a one-time shock due to the lockdowns. Now, to do this, we had to scramble a little bit, but this is also where the power of our painstaking approach becomes very clear. First, the fact is that we could do this. So we looked at all the firms individually and produced that were impacted and produced an estimate of the impact on their revenues of the COVID-19 lockdown. In fact, we had to return to these several times during Q1 as new information became available. And up to the last minute, we were revising our views on how different sectors, different companies would be impacted by the lockdowns. To find which companies would be impacted, we could use ticks. And that's where it became interesting because it's systematic. So by using a combination of filters for merchant companies, the transportation sector, assets that are tagged as either global or regional, that operate beyond a national economy, or assets that were in countries that were in lockdown, and also assets that were both projects or corporates. Here, there was no reason to select one or the other. We could get the firms that we thought in our database that we thought should be impacted, and therefore revise their forecasted revenue. So for each sector, the data team produced a document that reports indicates the revenues of each type of firm and how it will be impacted over the next several years. And then we include this in our revenue projections, and we include this in our dividend projections. And this, actually, the summary of this report is on our website. So, for example, in the table on the right, you see we made several assumptions in terms of how impacted the revenues of road assets, what companies will be in different countries. We've done that for a number of other sectors. So, of course, these are assumptions. They're based on our best judgments at the end of March. We'll also revise them as we go forward. But what is unique is that we can actually even try to do this because we have all the data. And it's because of where we sit in the data collection chain, basically. In other words, that's because we bother to collect and to clean the data that we can now take a view. And again, it's very documented. It's based on lots of other sources on why revenues in this or this sector will be down 20, 40, 25%, etc. So that's an important aspect of this release. Another key aspect of this, which I mentioned briefly before looking at the index performance, is the freezing of the indices. When this platform was launched last summer, it was still in beta mode, really, and a number of changes have occurred in the methodology. For example, the way we treat interest rates. We used to treat interest rates, for example, for all European countries the same. Now we treat interest rates for each European countries at the level of the country, etc. And the data has also changed and grown. It's also been improved. So that was still the research index, so to speak. Now, this release is 100% stable and will be frozen, meaning that from now on, it is what it is. Even though, of course, because it's private data, we get the data with a lag. So there's going to be several quarters of lag where the information continues to be estimated. But otherwise, the history of the index will now be frozen. This is an important step in this release and in this history of the indices. Okay, now let's look at the infrastructure 300 index. So this is an index that we've built, the Infra 300, to match the TICS segment of the universe, right? So again, to match the business risk, the industry classification, etc. of the universe. So on this slide, you can see the constituents of this index, 300 constituents to $200 billion of market value. And on the left-hand side, you have the index, and on the right-hand side, you have the universe that I was showing you earlier, the 5,500 in 25 countries. So as you can see, in terms of matching the business risk profile of the universe, we're very close. So that's good. In terms of industrial sector, we're a bit less close. For example, we're a bit somewhat underweight in terms of data infrastructure. So this is something that we'll also be working on, but that's acknowledged here. But this is the best match we can generate at the moment. We can also look at our coverage by corporate versus projects. So again, corporate infrastructure corporates versus project finance SPVs. Here it's not too bad either, but you can notice that we have more projects in the index than there are in the universe. And again, this is a feature of that's the best we can do given the difficulty of the data collection. But at least we're trying to go all the way to the mark to match the universe structure. And in terms of geographic coverage, as you can see, this is a lot less satisfying compared to the universe where North America makes up a quarter of the market. We're very underweight in terms of the Americas and overweight in terms of Europe. This is due to the current limitations in the data availability for unlisted infrastructure companies. Now, we are working hard to address this, and we will be receiving the help of several investors who have access to US data in the coming months, in fact, to redress this. But that's where we are today with the coverage of the market. In terms of covering the TICS exposures, so the different segments of the market, it's very close. If you don't care about the US market, our coverage is pretty much perfect. And if you do, then we're lacking some information there, but at least it's transparent. And I think that doesn't count for nothing. Okay, now let's look at the performance of the Infra 300 itself. Okay, so who could doubt that equity returns for unlisted infrastructure companies were lower and if often even negative in the first quarter of 2020? We know that, right? I mean, we had major airports, ports, roads, so their traffic collapse, often by more than half. Lower expected returns and dividends also means that investors require higher risk premia, not only for merchant assets, for assets that are exposed to commercial risk, but also for holding any liquid asset, including any infrastructure. So in the Q1 2020 release of the EDHECinfra indices, we capture both impacts on revenue and on risk premium. As you can see, the EDHECinfra 300 equity index is down minus 6.37% for the quarter. I won't annualize that, but that's a lot. It's less than listed though. And the most impacted sectors, Abhishek will go into that in a minute, exhibit returns that are more than twice as negative, okay? Now, while the COVID-19 lockdowns impacted performance negatively, it must be noted that this Infra 300 has had much worse quarters. For example, it was down minus 11.5% in the first quarter of 2009. In effect, some segments of the unlisted infrastructure universe are much less impacted due to the contracted nature of their business models. This is another example of the usefulness of ticks to understand your risk. If you look at things by business risk classification instead of core or core plus, or I don't know what, it's very, very straightforward what you're exposed to, or more straightforward. I want to say a quick word about the debt segment as well. As you can see, our debt universe is quite large. It has more than 1,100 live instruments in a $270 billion market cap universe. And comparing infrastructure project debt with corporates is interesting this quarter because spreads moved very differently. And while corporate infra debt had negative returns, basically the interest rates went down, but spreads went up a lot more. So you end up with discount rates that go up and negative returns. Project debt actually performed. The spreads spiked a lot less. Perhaps they'll spike more in the coming quarters. But for now, they haven't spiked as much as for corporate debt. And so project debt continues to have much higher returns than infrastructure corporate debt. I won't spend too much time on this, mindful of time. And now I'm going to, giving you the overview, I'm going to let my colleague Abhishek go into the details of 10 key findings. And to do this, he'll be using the EDHECinfra index platform. So Abhishek, if you can take over the screen.
Sure, thanks, Frederick. All right, so I would like to take you through 10 findings of infrastructure in this quarter. And I would do it through our online platform, which, by the way, is free to sign up. So if you haven't done it, please go ahead and do it. The first one, and it's quite important in the current atmosphere, that infrastructure is certainly not risk-free. And we see that with a negative 6.37% return in this quarter, which is primarily due to the impact of COVID-19. It's also seen through the historical volatility of around 12 to 13% over time since history, and which means that the returns are indeed volatile and not what investors are used to seeing from other indices in the market. This can also be seen through a quarterly returns time series. We see that the historical returns over time were quite large, negative, and coinciding with the significant market events, for example, the global financial crisis or the European debt crisis of 2012. And this implies that infrastructure, just like any other asset class, is impacted with the market movements. Related to the same topic, I would take you to value at risk now. which we can compute because of our calculated index methodology. We computed using a 5-year rolling window and a 10-year rolling window. And in the recent periods, we can see that the value at risk has been increasing. It's almost in the range of 20 to 25% now. We computed with two calculation methods, Cornish-Fisher and Gaussian method, and both of them have been increasing over time. In fact, if I show you the comparison, both have converged in the recent periods, indicating that the increase in value at risk is primarily driven by the lower returns and the higher volatility. Now, moving on to the third point, another related and quite relevant risk metric is the risk premium, which we see has increased by almost 80 basis points in this quarter. So it used to be 6.35% in 2019 Q4. It has increased to 7.52%. And that signifies that the overall risk in infrastructure equity index has increased in this quarter. And be mindful that this is a weighted average for the overall index. So there are companies which were less or more impacted, and we will see that in a bit, but the overall risk has definitely increased. Now, for the fourth key takeaway, I'll quickly take you to the debt index and show you the most relevant metric, that's the credit spread. So we can see that the credit spread in the last quarter has increased from 143 basis points to 203 basis points. That's a jump of 60 basis points in one quarter, indicating the higher credit risk in the infrastructure debt market. But if I compare this with project finance index, this jump is less prominent and less pronounced. So there's a jump of 35 basis points. This basically means that the project finance debt is perceived to be less risky than the debt issued by large infrastructure corporates. Now, I would like to take you back to the equity and talk about some of the key differences between different types of sectors and subsectors within equity. So first, again, highlighting that there is a negative 6.37% for the index. But if we look at, say, any given business model, I pick a contracted business model, there is a negative return of 5%. So it has done better than the overall index and suffered less in this quarter. And that's understandable because their revenue forecasts are less linked to the overall market movements, and they sometimes even have concession contracts. Whereas if I compare that with a merchant index, the negative return is much higher, negative 9.6% in this quarter. And that's again going back to the same point that their revenues are directly linked to the market changes. As an example, within merchant, if I compare only road companies, so these are merchant roads, and we see a significant hit of 13.5% in just one quarter. And that's quite understandable as well. Their main revenues come from the vehicles being on the road. But with the worldwide lockdown, there are no vehicles out there. They see a significant drop in the returns. Similarly, we can look at the airports index, which is made up of both merchant and regulated assets, and we see a drop of negative 10% in this quarter. So I think the key message here is that while overall infrastructure has a negative return, there are differences between different sectors and different business model types, which is why the overall effect that we see at the index, the main infra 300 index level, could be less pronounced than the individual effects. All right, and with that, I'll take you to another key interesting finding. That's the size effect. So if I compare a small size index, so there are 128 companies which belong to the first quartile by size in our universe, we see a return of negative 3.5%. This is definitely much better than the overall index. And if I compare that with, say, the large size index, so these are the largest fourth quartile companies in our index, there are 120 companies. they have a negative 8.8% return. So the spread is quite wide. It's about negative 5% spread between the two indices. And the reason is the allocation within these sub-indices of size. If we see the largest companies index, it's primarily made up of merchant and regulated companies. Almost 70% companies within this index are merchant and regulated, whereas contracted is around 30% companies. Whereas the smallest size index, bear with me for a few seconds, it has 70 to 75% allocation to contracted business model. And then this ties back to the previous point that the contracted assets have suffered less in this quarter than the merchant assets. Another interesting thing I wanted to show you is the effect of duration in infrastructure. We all know that infrastructure is a long-term investment. These assets have a very long life, so duration must play an important role. So this is the duration of the small size index, which is about 7 to 8 years in the recent period. If I compare that with the largest size index, so the size 4th quartile index, the duration in the recent period is almost 12 years. So here, there is a very interesting message coming out that the larger assets have longer duration and thus are more prone to interest rate movements and the risk premium movements, which is again tying back to the overall story that the contracted assets could have performed better than merchant assets, and the size indices, the smaller size index has done better than the larger size index. Another key takeaway here is the expected returns. So we noted that in the first quarter of 2020, the interest rates worldwide went lower. But even then, the expected returns or the final effective discount rates, they went higher in first quarter. This is the significant impact from the risk premium. The expected returns went higher more than 80 basis points. And this is not just on the weighted average. So this particular chart is for the weighted average. But if I compare that with the quartiles here, we see that all the quartiles have increased in this last quarter. But the magnitude is different. So if I show you the smaller quartile, so the smallest 2.5 percentile of the companies, they already had small expected returns. So the increase is much smaller as compared to the rest of the index. This again goes back to the fact that suppose social infrastructure, for example, it relatively has smaller expected returns. So we will see the smaller impact of COVID-19 in this sector. Now with that, I wanted to show you one key thing. We talked about the risk in infrastructure, the negative returns in this quarter, but one thing remains constant and attractive to investors, that's the cash yield. So this here is the year-on-year cash yield throughout history. And we see that it has been quite attractive. It has been more than 7-8% over time. Even in the last quarter, it's more than 8%. And this is why infrastructure is special. This is what makes infrastructure more like fixed income and attracts investors in this asset class. This is also the reason why the historical performance of this index has been so good. We see more than 14% since inception return and a very attractive Sharpe ratio in this asset class. So these were the 10 key findings that we have from the Q1 release. And with this, I'll hand it over back to Frederick. Frederick?
Yes, hi, thank you, Abhishek. Let me just go back to my slides. And there you go. Thank you. So I'd like to follow up on this with a little poll. So I'm going to, never done this before. I'm going to launch the poll and we'll see what happens. You may or may not see something in front of you. And we have two questions. One is, has the infrastructure asset class been fundamentally changed by the COVID-19 episode? Yes or no? And does this crisis confirm that absolute return benchmarks are not adequate for infrastructure investment? All right, well, we have a whole bunch of answers. Thank you for providing your feedback. I'll let that run for a little bit more. We have a clear winner in both cases. All right, so has the infrastructure asset class been fundamentally changed by COVID-19? Most people say no. And I think that's correct. There are risks in infrastructure investments, and the COVID-19 lockdowns have only highlighted some of the risks that were there all along. While infrastructure is often touted as being different from the rest of the economy, it does not follow that it is uncorrelated with the economic activity. Instead, infrastructure companies are the backbone of the economy, which means that they are exposed to very deep-seated risks that investors should not ignore. Now, for a decade, investors have increasingly focused on real assets, partly as a response to the financial crisis of 2008, when the financial sphere contaminated the real economy. And then this crisis is exactly the opposite. It's the real economy crisis, which is gradually contaminating the financial sphere. But the COVID-19 lockdowns did not change the risk profile of infrastructure assets that investors hold today, I think. They are the same infrastructure asset that they held at the end of 2019. Their long-term value, their business and financial risks have not changed. What the COVID-19 lockdowns have achieved better than any stress test or downside simulation is to reveal some of the risks that were always present in the businesses and that are at the core of the economy, because they're at the core of the economy. You could say that the stability of infrastructure assets is conditional on the economy itself being stable. In the event of a large shock, even infrastructure assets become more correlated with other asset classes. And this is exactly what we're seeing. Right, so that makes sense. So once again, it doesn't mean that infrastructure is somehow has lost its appeal or is all broken. In fact, as Abhishek was highlighting, there are plenty of sectors that are doing perfectly fine, especially because they have a contracted business model or they provide services which are even more useful now. But the potential for drawdown, the potential for a rapid decline in value of some types of asset, at least, which was kind of hidden and certainly wasn't visible in the sort of appraisal-based indices that exist, is now there, and luckily we can measure it. Now, second question, does this crisis confirm that absolute return benchmarks are not adequate for infrastructure investment? A slightly interested question on my part, you will forgive me for that, but I'm glad to see that we also have a clear winner here. In fact, I'm curious, what are infrastructure investors going to do this year with benchmarks that are absolute return benchmarks defined as the risk-free or inflation rate plus a spread of 405 basis points? Is everyone who invested in the transport or probably any merchant asset going to underperform? That sounds bad, especially for the end of year bonuses. It would be a lot more relevant to ask how these people are doing relative to the market, given the investment choices that they have made. Okay, so with very bad benchmarks like these absolute return benchmarks, it's not possible to tell which managers or which investment team made the right choices and which ones didn't make the right choices. If the market is down 7%, but you're only down 4%, then you're doing okay. Well, still being under your absolute return benchmark. So I think the realization amongst investors that infrastructure assets represent significant risk exposures and that these should be understood and managed will determine, in many ways, the coming of age of this asset class. For asset owners, a better understanding of the risks related to infrastructure assets will help them to document the risk that they're exposed to. Okay, it will promote switching from absolute return strategies to benchmarking performance relative to the market index. or a customized benchmark that best represents the risk that they have in their portfolio, and it will better align fees with managers. It will also allow the integration of infrastructure assets in a total portfolio, strategic asset allocation, asset liability management. Now that we can look at volatility, we can look at correlations, we can have answers for these things. In fact, EDHEC is finishing a study on the role of infrastructure in a portfolio, both from a strategic asset allocation and ALM perspective, because now we can measure volatility. Before, you couldn't answer these questions. And for asset managers, I think showing which systematic sources of risk they're invested, they're exposed to, will help them, because it will help explain which part of performance is driven by risk factors that are within their control and those that are not within their control, beyond their control. It will demonstrate their ability to deliver a well-diversified infrastructure portfolio in terms of risk and rewards, which is a mean feat. As you all know, it's difficult to invest in infrastructure and to find assets and to build portfolios. It's probably, in fact, more important to deliver something that looks like the benchmark, the promised strategy, than to outperform it. And because it creates more value almost. And then, of course, you can still show that you are performing if you're comparing yourself to the correct benchmark. So I think this will be in years to come, gradually, but this will have started now with COVID-19, the beginning of the end of understanding infrastructure as an absolute return strategy.